Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We have been really interested in the world of private equity recently. It certainly is capturing more headlines, it's capturing more invested dollars, and some of the deals that we're seeing in that space are really interesting. And luckily for us, with the platform that we've built here at Equity Mates, we can get some of the biggest names in private equity in Australia into the studio to come and talk to us. And we've got a returning guest who fits that bill and is giving us some more time to take us through what is going on in the world of private equity. Cameron Blanks, welcome back to Equity Mates.
Yeah, thank you very much, Bryce and Ren. It's great to be back. Excited to be here.
Yes, we've brought in the big guns. Now, Cameron is Managing Director at Pacific Equity Partners, been at the firm since 2002. And today we're covering off why private equity, but specifically we're going to be looking at late stage buyouts and how they seem to consistently outperform and provide a lot of value, especially versus public markets. So really looking forward to today. But Cam, to kick off, we'll start more broadly just around private equity outperformance. Let's start with the numbers. How has it outperformed public markets?
Yeah, look, over a very long period of time, it's sort of outperformed somewhere between 5 and 10% on average. Obviously, there's some sectors within the industry that have even done better than that. But just as a general rule, public equities over the long term have delivered something like 7 to 8% returns to investors. Obviously, volatility is in those numbers, and private equity is typically about 5 to 10% above that, and with less volatility as well.
This is also the part of the interview where we feel bad that we have all of our assets in public markets, but the good news is that this world of private equity is becoming more accessible. There's funds that we'll talk about later, and also there are some publicly listed private equity managers.
Yeah, absolutely. And look, it was never designed for individual investors. Traditionally, the private markets and private equity have been really only available to institutional investors, and there needs to be a bit of repackaging, to enable individual investors to get access to the asset class. And as you've mentioned, that is starting to happen, and that accessibility is starting to be available.
And you guys are driving that in Australia with your Gateway product. Last time you came on the show, we unpacked that in detail, and we'll touch on it throughout this episode, but people can look it up and see if it's right for them. But that is a way that's sort of bringing the initial cost or the initial investment down in the private equity space.
Yeah, and I think it really focuses on like the all-stars of global private equity. So we think it's a great product, not only accessible, but also, it really does deliver great returns to investors.
And it's particularly focused on later stage buyouts.
Absolutely.
And you mentioned there that overall as an asset class, private equity has outperformed sort of 5 to 10% a year. But the outperformance is particularly noticeable with late stage buyouts. So can you give us some color on that? First of all, for people who are new to that term, what are late stage buyouts? And then how have they outperformed, I guess, the broader private equity asset class?
Yeah. So look, there's a few different categories when people think about private equity, and it sort of starts with venture capital, which most people, really are fairly familiar with, providing seed and growth capital for, early stage businesses. The next category on from that is growth equity, and this again is typically minority positions, capital for growth, and then you end up on the other end of the sort of risk spectrum, which is what we call late stage buyout, where you're buying, large established businesses, that are cash generative, often with iconic brands and names that people are familiar with, and then really reinvesting in those businesses, reinvigorating them for growth. So when you look across those, three different parts of the private equity market, you see a lot of volatility in the venture capital world because obviously, you hit a canva and you do very well, but if you miss the canva, you don't do very well. And there's a lot of early stage companies that never make it. So overall returns tend to be quite good in venture capital, but a lot of volatility and a lot of sort of underperformance as well as overperformance. And that sort of when you migrate up to the late stage buyout, that volatility in return starts to decrease because you are dealing with much more cash generative businesses, and it's about executing strategies behind those. So it does tend to outperform on average because of that dynamic.
Now, let's drill down into what is driving the outperformance. You've shared 3 key reasons why private outperforms public. Before we go through each in detail, perhaps at a high level, can you just go through what the 3 main drivers are for outperformance?
In late stage buyout, the real 3 different things that differentiate and enable that outperformance is number 1, alignment. So this is getting alignment for all the way from shareholders through the board and into the management teams around incentives and strategy and execution. The next one, number 2, is really about active management, and what that means is really spending time with the management teams as a private equity firm to make sure that they're executing the strategy and then helping them to execute that strategy. So that may be some analysis, it may be some help with M&A, bringing in other specialists and the like. And then thirdly, we can take a long-term approach in private equity. We obviously would like to sell our businesses after 3 to 5 years, but if we need to, we can hold on for longer than that, depending on market conditions or where we are on the business execution. So we have that flexibility, that long-term flexibility that doesn't really exist in the public markets. There's always a 6-month or quarterly reporting that needs to be done, and it drives short-termism. So, we'd put those 3 aspects down as the reason why, particularly late stage buyout outperforms the public markets by, a considerable margin.
And so what we wanted to do in this episode was really bring those 3 factors to life. And, you've had 20 odd years at Pacific Equity Partners. So we figured you would have a wealth of examples that you could draw on to sort of illustrate them. And so for each, we want to go one by one through these examples and use a case study to sort of show how that has come to life and I guess driven great outcomes. So let's start with alignment of interest. I think the case study here we're going to use is Peter's Ice Cream, unless you want to switch it out.
I'll talk about Peter's. I'll also touch on another one called Tegel Chickens over in New Zealand very briefly at the end of the Peter's Ice Cream, just to bring it to life.
My wife loves Peter's. So
Everybody loves Peter's.
I know, who does?
True.
Yeah. So before we talk about alignment of interest specifically, let's talk about the deal generally, how it came across your desk and how it came to be, and then we'll go on to the improvements.
So look, our focus at Pacific Equity Partners is on corporate carve-outs and take privates. We like those situations most. We do a few other deals, but those 2 categories would add up to more than 80% of the deals that we've done over 26 years. So we've got an expertise, particularly in corporate carve-outs, and it's very important for large multinational companies or big domestic companies when they're actually dealing with private equity. They're dealing with a party that's got experience about carving businesses out, because often these companies are matrixed into the organisation. They have a lot of different touch points in the different divisions within these large multinationals, and they're on their IT platforms, and that often they can sometimes be global brands, like is the case in Peter's, where they want to make sure that you're going to be a good steward of that brand as well. So actually having a reputation of being able to execute these sort of carve-out deals and be good stewards of the companies after you've carved them out is actually very important to these multinational companies. So, given we've got a track record of doing them, that really differentiated us in the Peters example.
And what was the process? Was it a bidding process?
Well, it was a limited bidding process for that dynamic. So the Nestle, who owned Peters, had appointed JP Morgan as their advisor, which is often the case in late stage, large scale private equity, because these are big businesses. Typically there is an investment banker involved along the way. So in this example, it was JP Morgan, but again, it was about flying up to Vevey to head office and explaining ourselves about why we were a good steward of the business. So, and then being able to execute the process in a very condensed period of time and actually outpace other people that they were talking to, and actually be, at the negotiating table with a very clean bid where they could execute it in a very rapid period of time was really our differentiator in this example.
Wow.
Is Vevey, is that Nestle's head office in
It is
Switzerland?
in Switzerland,
Okay.
yeah. It's beautiful, by
I
the
can
way.
imagine.
Yeah.
I was just trying to Google because
It's sort of just around from Geneva. So,
okay.
on the lake, on Lake
Gee.
Geneva.
Did you just bunk in there until the deals are done? Or
Yeah, we do. And, it's a pretty intense process. And I think this one, ran over about a 5 or 6 week period, but we'll have, maybe 6 or 7 people from PEP working on the deal. But then we've got a large advisor group that might be, accountants, lawyers, consultants and all that. There'll probably be 50 odd people working, on these deals for a very intense period of time. So, being able to execute, arrange all the financing to do these types of acquisitions is a real skill set that, requires experience.
Yeah. Now I'm just imagining all the cohorts that went and took their 50 people teams and didn't get the deal.
Worth it though.
God, it'd be a
Yeah.
tough flight back.
Yeah, absolutely. Yeah, 100%. Yeah.
So let's talk about incentives and alignment of interest, and I guess maybe talk to us about it pre-deal and then how you realigned incentives and interest in the company and sort of how that changed behaviour and what that led to.
Yeah, so if you can imagine Nestle, it's a $100 billion global company, mainly a coffee company and a chocolate company. And so Peters was its only ice cream business that had left in its whole global network down here in Australia. So you can imagine it was a pretty unloved division and unfocused on division. And in those big systems, which makes a lot of sense from Vevey, so none of this is meant to say that Nestle aren't smart people, they clearly are. But if you can imagine what happens is the small, unloved Peters ice cream is matrixed into the organisation. Typically, they have big management programs where they move people around their world around the world to sort of do management training. Well, a great place to train, a relatively junior manager is to put them in charge of the small little ice cream division down in Australia.
Yeah.
So expats come down here for a couple of years on their training program, and there's no real incentive to try to maximise the profit. It becomes a game of expectations management. If you can just promise that you'll do a little bit better than last year and you'll get your bonus, and you'll do that for a couple of years, and then you'll move off to your next global assignment. That's the type of motivation incentives that happens in these large organisations. So, really part of what our job is to do is to start to really focus the business on, reaching its full potential once it's outside of those, large systems.
Now, you didn't hold the investment for that long in the end. You invested in 2012 and exited in 2014. So talk to us about what you changed in that time period and the financial result, and then maybe a little bit on you only held it for 2 years, so why the exit? Yeah.
Well, look, we had a plan that was a 5-year plan, and that plan, involved, as I say, carving out the business. We had to stand up all our own ERP systems, IT systems to do that. We got a very, very good chief executive, and that's, often, the recipe for success to run the business, a guy called Steve Audsley. He had been running Breville, so this was actually a relatively small company for Steve to set in. Once you get a good chief executive, they tend to hire very good people as well. But he had to actually stand up the company as its own company with its own P&L, its own balance sheet, its own cash flow. So that takes a little bit of time. But again, it comes down to having the right strategy, setting the right incentive for Steve and his team, and then helping them achieve that strategy. So, some of the things that, very simple things that Steve was able to do was, rather rather than follow the big Nestle new product development, program or some of their global policies. So some of those, just for example, were you can't market to children because we're a coffee company. Well, this is an ice cream business, so that's a rule that you can start to break. Another rule is you can't do any private label because they're very worried about brand erosion if you're working for Audi in Europe, which in Europe, there's a very high penetration of private label. So, but here in Australia, you've got a half-empty ice cream factory, so you can start to do some private label for Audi. There's lots of these types of examples as we go through, where if you've got a focus team with the right incentives, executing a strategy that we've sort of set out for the management team and agreed with the management team, where they can make a lot of money if they execute that strategy successfully. The energy in the team goes up, the quality of people goes up, the focus goes up, and the execution happens much faster than you expect. So what actually happened was we delivered a 5-year plan in a 2-year period, double the profits, and then we were approached by a big global ice cream specialist company to actually buy the company. So it was one of those sort of situations where the IPO market had opened back up, so we were able to run basically a dual track process with an IPO fallback, but our preference was always to sell to this large trade buyer.
Wow. Double the profits in 2 years.
Yeah, well, it's great brands. If you think about Peter's Ice Cream, it's things like Drumstick, Connoisseur, all this type of thing, and just a bit of innovation going on in the business. Like you may not remember, but before we bought the business, you had Magnum was the only ice cream with chocolate with nice high quality ice cream on the inside. It was actually us that put Connoisseur, beautiful ice cream, on a stick.
Oh wow!
And that was an innovation that we thought was pretty obvious in the business, that obviously had been missed as a direct competitor to Magnum. So some of that type of innovation just wasn't happening in the business, as an example.
Well, I may have doubled your profits alone hearing that. That was a game-changing innovation in our household.
So Cam, before we move on to the second reason, you did mention Tegel cheese. So what was the story there?
Yeah, it was Tegel chickens. Cheese and cheese, they don't know. But anyway. So look, this one very quickly. It was over in New Zealand. It was actually owned by Heinz, but another great example of incentives and how they drive the wrong behaviour. Heinz, it's predominantly a ketchup business, if you like, over in the US, and so the way that management team globally is incentivised is on market share. And if you could imagine, in all of the supermarkets in the US, if you can increase your market share by 1%, you end up with a good flow through to profit. So globally, market share, but you then go over to New Zealand into their chicken business. They had actually won market share hugely. They'd taken market share from about 40% to 65%. They'd spent a lot of capex growing out capacity to do that, and they had halved the profits of the business. Because the way that you grow share is you drop price. And if you don't have good control over price, it's very easy for management to go and win share by just dropping their price. So that was a great example of just changing the strategy to say, no, we've got to go to value add. We've got to think about realisation of value for the chicken we're producing, and it's okay if we lose a few points of share, but we'll actually gain profits by providing value-added products into the market. So a great example of just a very simple shift in incentives and motivations to a more than doubling the profit in that example.
Wow. It's a funny one. It's like those examples you think, first of all, like, how did these businesses get tacked on? And, it's probably part of some, like, big multinational
Correct.
deal.
Yeah.
And then you think, well, like, that insight around we can double our profit if we're not so worried about market share. It's like they could have had that insight. But again, I guess it's just a focus thing.
It's a focus thing. Yeah, this is where, obviously if these businesses were core business for Heinz or for Nestle, those sorts of opportunities probably wouldn't exist because they would be doing logical things. It's often these sort of non-core divisions, small divisions in far-flung places where you don't quite get the focus or the management talent to go and execute.
Yeah, it's fascinating. Just makes me think how, like, you think about, like, what's the opportunity set for private equity, and then it's like how many of these, like, small,
There's a lot.
unloved companies.
And they've got great brands and they're iconic names, but just sort of tucked in these large multinationals.
Yeah. So let's move to the second reason that you mentioned there, active management, operational improvement. And I when I was thinking about this, I imagine part of it is like you're here for a good time, not a long time. This isn't like a 60-year ownership. You're not building a career here. You're trying to maximize value and then move on. So we're going to do the same thing again. We're going to use an example from a deal that you guys have done to bring this to life. Asalio Care is the company. So before we get into active management and operational improvement, can you introduce us to Asalio?
Yeah, so Asalio Care, most people would know it as sorbent toilet tissue or Libra feminine hygiene products or Tena incontinence products. So it's a tissue business. It actually originally was called Carter Holt Harvey Tissue, so another good iconic New Zealand business. Owned the main factory in Box Hill in Victoria. So for your Victorian listeners, most people know the sorbent toilet tissue plant in Box Hill. So a very iconic business. We were actually the underbidder to a big Swedish paper company, which is now called Essity, back in 2004, where they outbid us to buy the business off Carter Holt Harvey. But we could see that it was a very good business with great iconic brands. Sorbent, I think, it was probably found its way into most homes in Australia over the years. We all remember the adverts of the very excited little boy running around the streets after he'd been to the bathroom. So it's it's one of those very iconic type brands, and we thought that there was a lot of operating and performance improvement opportunities there. So Essity had actually owned it for 7 years. We have one of our founders is Swedish. It's based in Sweden. We'd spend time in Sweden trying to convince Essity that we could help them with their far-flung Australian business. It was the only business they had down in this part of the world. They were a dominant player in Europe, but not down here in Australia. So, effectively after 7 years of ownership and really neglected ownership at some level, they really tapped us on the shoulder and said, yes, we'll sell half of the business to you. Come in and help us run and improve the business. So it was a classic example of a corporate carve out, but a joint venture where the corporate could actually enjoy the benefits of the work that we were going to do with them.
Wow. And so what were the key, I guess, operational improvements that you brought in, and who were the people that you brought in to do it?
Yeah, so the business had not had a lot of capital spent on it during that 7 years because Essity had better use of capital in Europe, or at least that's where the capital's going. So they'd let their plants run down to the point where a lot of their machines and production lines weren't as efficient as they could be, and some of this is really large scale capital because you're building paper plants and the like, which do need a lot of capital. So it was about coming in and doing a very detailed assessment on how to actually improve the productivity, reduce the cost to serve. Sorbent is the number one brand, but there's some other very good brands in the market like Kleenex, for example, or Kuton that you're competing against. So actually having low cost production is very important to be able to compete in the market in that example. So it was a really heavy operating performance improvement deal opportunity for us.
What was that like? So, your joint venture partner has underinvested in this company for 7 years, and you come in and you say, look, there's an opportunity here, but we need to invest. But they have been underinvesting. Is that a hard conversation?
Well, not really. No, they knew they'd been underinvesting. They just didn't want to apply their capital in Australia. They had, the use of their capital for them, from their perspective, was better used in the European market. So that was part of the reason that they actually got us on. So we could organise all the financing and organise all the capital that needed to be spent in the business. It was very ironic, actually. The COO, the global CEO, COO, so Chief Operating Officer for Essity, had never been to Australia, even though they'd owned it for 7 years. A few months after we bought the business, he actually came for the very first time. And that was really helpful, hugely helpful. So it's kind of ironic when you think about it that, hadn't bothered to come down until after he'd actually sold half of the business. But it was actually to set the strategy and the operating cadence for the business.
Do you have a pool of execs that you kind of tap on the shoulder?
Yeah, we do. And we brought a few into this situation. The CEO, Peter De Plaris, had only just started. The Essity guys had actually chosen Peter, and we'd decided that he was actually a very capable person, and they'd chosen the right CEO. We did make some changes during it, and probably one of the biggest things we did to really change behaviours in that situation is we changed the way that the management structure worked. It was based around a functional organisation. So you had, a sales team that was responsible for selling sorbent toilet tissue, Libra, feminine hygiene products, and Tenor, and it was and then you had operational people who were responsible for making all of the products. So very functionally driven. We changed the structure so it was business unit driven. So you had a head of tissue or toilet tissue with sorbent. You had a head of feminine hygiene. You had a head of incontinence, and you created P&Ls and accountability for the products end to end as opposed to a functional organisation. So that, again, drives different behaviour, it drives innovation and the like. So, getting that organisational design right was very important to deliver the cost savings and the improvements that we needed to.
Yeah, it's fascinating. So talk to us about the results. So you made the changes and then...
Yeah, so this one was obviously done in joint venture. Over about a 3 or 4 year period, we more than doubled profits, and then we actually listed the business. So it became a public company. We sold out at that point, but Essity wanted to stay in, and actually they did end up rebuying the business off the public markets. So it was quite a journey. And a very good journey for Essity. They made a lot of money out of the transaction they wouldn't have made without our help. Obviously, it was a good deal for us, and certainly for the management team, did a great job and were rewarded more than what the global CEO of Essity was, which it caused a bit of ruction with them. But that's the private equity model where we can genuinely reward our CEOs and leadership teams for outperforming and delivering a great outcome for shareholders.
I'm imagining it would be a pretty good job to be like an executive on the bench with connections into private equity. And
Definitely.
It's like, you're getting parachuted into this company, and then 3 years later that company.
Exciting.
Like, it'd be an exciting life.
Yeah, it would be. Look, it's really interesting because in the 20 years ago when I started in the industry, we'd have to explain to executives what private equity was, and generally, that it was seen as being a CEO of a public company was, the pinnacle of the professional world. That's really changed over the last 20 years. Now I think you'll find that most really good chief executives would prefer to be a chief executive in a private equity style opportunity rather than a public company. See, obviously that changes, right at the top end, a CBA or, some of the really large banks and very large companies, that's probably a different story. But once you get out of sort of maybe the ASX 20, I think most of the CEOs would probably prefer to operate in a private environment.
But it just reminds me of the John Mackey, the Whole Foods CEO, who took his company public and then hated it so much that part of the reason he sold to Amazon was he just hated the quarterly reporting cycle and being public as a CEO.
Yeah, exactly. And there's I think part of that alignment of interest, active management that we were talking about is, having a relationship with the CEO and CFO and the management team where we can make very quick decisions. We're sort of part of the decision-making body, so we're not going, back up to formal monthly boards with non-executive directors that aren't as close to the business. So that active management is a very important part of why, private equity is actually able to deliver profit improvements that often aren't made in public companies.
It makes me think and this probably already exists, but that model where there's a neglected part of a large corporate that could do with focus and operational improvement and investment. And so they did a joint venture with you, and it doubled its profits. It makes me think, is that something that big corporates do more often? Whereas they have the first option to buy it back at a certain period of time?
Yeah, I think in the right circumstances, we're seeing a few more of those deals. They're still relatively rare because often, a big corporate will make a decision to sell because it's a non-core division. And so, it takes a bit of thought on their behalf to say, well, actually, I'd like to keep some of it because I know that you're going to do very well. But we do see it from time to time, and we're certainly very open to partnering with big corporates. We think we can add value, and if they want to enjoy some of that value creation alongside us, we're very open to doing that.
So Cam, we've covered off alignment of interest, active management and operational improvement, which leaves us with the third reason for outperformance, which is that ability for you guys to be flexible but take a long-term view. We'll look at this again through the case study of Vita. So before we get into it, perhaps introduce us to the company and why was Vita so attractive?
Yeah, so Vita is Australia's largest credit bureau. It was actually formed by the big four banks, pooling their data and enabling all of the banks then to look at the full credit history of people. So it was a public company, Vita. It's it was $1 billion public company, and it really lost its way. They'd actually got into debt collection, and then they'd got out of debt collection, and there was a lot of confusion at the board and management level around really what was the strategy for Vita. So this was another example of the type of deal opportunities that we look at. Often, more than 50% are corporate carve-outs. Well, then, 30 or 40% of them are take private. So this was a classic take private where the market had sort of lost faith in the board and management. Share price hadn't been performing, but at its core, it was a really dominant provider of credit information, for all of the different financial institutions in Australia. Today, it's actually called Equifax, and I'll get you to Equifax, but when we bought it, was called Vita.
And so the process of buying it, was it were there large shareholders that you got on side, and was it a pretty smooth process, or will you, for this one or for other take privates that you've done, will you take like a minority stake and start, trying
hostile.
to, you're not, or maybe not hostile, but put a bid price out?
We don't tend to do minority stakes. There are other private equity firms that like to go down that path. Typically, the way that we execute these public privates, and Vita was exactly like this, which is to go and actually approach the chairman. And, obviously when we approach them, we need further due diligence. So, the proposal that we're putting to the chairman, is not able to be accepted at its current form. So therefore it's not a disclosable event, and it enables us to come and do the work and make sure that we, are actually firmly at the price that we've been discussing. And so it's actually these take privates are often done completely behind closed doors. And the first time that the public market investors hear about them is when the share implementation agreement is announced, and that there's already been an agreed deal with the board of the company, and they are recommending the proposal. Obviously, those proposals are always subject to fiduciary outs. So if another private equity fund wants to come and outbid what we've agreed, then they're obviously free to do that. So it's a very good mechanism, the way that take privates work in Australia, but that's actually how they work.
Yeah, okay. This is all about being able to think long term but be flexible with your approach, not worry about the quarterly or half yearly reporting cycle. So talk to us about, you take Veda private. How does that sort of factor come through?
Yeah, so one of the really, at the time, so this was 2007 that we took Veda private. So, one of the really interesting opportunities that we saw with Veda was the legislation was in front of the Parliament to put in positive reporting. So up until this happened, which took quite a few more years, which I'll get into, but you could only do negative reporting. So if you didn't pay your bill on time, you had a black mark next to your name. What positive reporting was going to enable is that it actually also recorded all the times that you paid your bills on time. So a financial institution that's assessing whether to give you a home loan or an auto loan or a personal loan could look at your credit history and see that how often you paid on time and get a full picture of, or a comprehensive picture of your credit history. So it was good legislation that was going through the Parliament. It was actually took a long time to get through the Parliament because the banks weren't very happy about it, because they already had all of that information. So it was taking away their asymmetry of information that actually handed the banks, a competitive advantage. We had looked at examples of this around the world, of when countries went from negative reporting to positive reporting, what the increased inquiry of the bureau was, or the credit bureau, which was Veda, the business that we were managing, and it was up to 5 times the amount of activity. So Veda for us was really we had a lot of other opportunities we thought were there, but the really big bet for Veda was backing ourselves that this legislation would get passed. We would spend a lot of IT, a lot of money, like hundreds of $millions in IT, getting ready for this comprehensive reporting. That was the investment thesis going in, and the public market was never going to allow the board of management to spend that sort of money getting ready for legislation that hadn't been passed in the Parliament.
And so the last 2 examples had been double profit in 2 years. How did this one turn out?
So this was still a double profit, but it took us 6 years to get there. And I think this is some of the we still did very well. We got a multiple uplift because of the growth prospects of the business. Still a very good deal for us, but it sort of transpired in a different way than the other 2 that I described. And it sort of goes to this long-term, flexible capital that we've got, and without having to get exposed to the volatility in the market. So I mentioned we bought this business in 2007. We all know what happened very shortly thereafter, which was the global financial crisis. The markets were incredibly volatile, and if this business had still been in the public markets, there's just no way they would have spent the capital that we continue to spend all the way through the financial crisis to get ready for this comprehensive reporting. So we think this is a great example of continue to invest regardless of what's going on in the market. And then you can time when you bring the asset back to market. So this one we did actually IPO. So this was actually the very first business that got IPO'd in about 2014 that reopened the IPO market after the global financial crisis. It was a very successful IPO. We held a lot of our shares into that IPO, and then very fortunately Equifax turned up, which is a global credit bureau, and bought the business for a substantial premium to what we had listed on.
Wow.
So it was a very good and successful deal for us, but it came off the public markets, stayed with us for about 6 years, where we invested $200 million in IT and system development, expanded the product suite that it was selling from a big data perspective beyond just bureau, listed the business, and then had it taken over by Equifax.
It's really interesting, like, as you tell that story, like, if you think about, like, at its core what the function of public markets are, like, a lot of it is one is to enable liquidity for existing shareholders, but it's also to create a forum for companies to raise capital.
Yes.
And they can issue shares and raise money. And the story that you tell there about how the company needed to go private to access the capital to do this big investment, which ultimately was like really created a lot of value. It's kind of like the core function of public markets wasn't really, it's kind of been superseded by like these deep-pocketed private markets.
Yeah, I think that's right. I think superseded is the right answer. If you go back 20 years ago, it was a real rite of passage for a company to go, and list on the stock exchange and ring the bell at the stock exchange. That was a rite of passage, and really what that was all about was all of a sudden that company had access to capital to grow. But there's really no need for companies now to go public if they don't want to, because there's plenty of capital available in the private markets. And that's why you're seeing a lot of companies staying private for longer before they go. There's clearly a function for the public markets, and we're certainly not advocates of 100% private markets and zero public markets. It's just that it is a different tool, and particularly for these types of transformational opportunities, not steady state, with lots of disclosure. So the things where there needs to be a bit of a longer term perspective taken, we think the right place for a lot of those opportunities are in the private markets rather than the public market.
Yeah.
Well, Cam, we've just spoken about 3 exciting case studies that have been available to those in the private markets. To close out, what are the options for non-institutional guys to get in and access some of these deals?
Yeah, so look, this has been an evolution in our industry, and really over the last 3 or 4 years, you started to see what's called evergreen products coming out and being offered, and these products enable individual investors to come in and out of the investments as they're they're not meant to be sort of tradable products. So while our version of this is called PP Gateway, investors can come in 1 month and out of next month. We'd certainly suggest that they don't approach it that way. They can do that, but the idea is you invest money and leave it in there for 3 to 5 years to enjoy the capital growth in the businesses that we're doing. But we're also very conscious that for individuals, life circumstances change. They might need to buy a house, or there might be a divorce, or there might be a death in the family, or a need for a very large European vacation or something that
always
happens with individual investors, and they may want their money back sooner than that period of time. And if they do, we've got a structure that enables them to redeem their money with only 15 days notice and have their money by the middle of the following month, which means that it is a much more accessible product for individuals than the traditional institutional products that don't allow liquidity. You've basically got to stay in until the companies are sold.
Yeah. So I think that's for people who aren't as familiar with private equity. Like the traditional private equity fund is you would raise a fund for like a specific, like it's a specific vehicle. You would go and acquire however many companies, turn them around, and then once it was all done, you would return that money to investors.
Yeah, as you sell each one of the companies as you go through, the money's returned. So
and then you'd raise another fund to do the next round of
exactly. That's how private equity traditionally worked, and it was always funded by big institutions, not by individuals. So,
but this one is evergreen. You keep that money in the fund, do the next deal, keep it in the fund, do the next deal.
Correct, and you just recycle capital, and people can redeem. So they still, provide very good returns. It's just taken a while for the industry to sort of figure out how to actually deliver these evergreen products to individual investors.
Well, it's very exciting for us because, every time we speak to you, every time we read about private equity, like it's a exciting asset class, and the fact that it's becoming more accessible is great to see.
Yeah. Well, I love the industry. Obviously, I've worked in it for 20 years, so it's been a really interesting interesting journey to sort of watch the whole industry grow and mature and develop. It's now a very large industry globally. There's somewhere between 12.5 and $15 trillion in the private markets these days. So it is very sophisticated. We're institutionally like in our practices around governance and ESG and all those types of things. Long gone are the days where private equity was seen as a fairly fast and loose industry. It's not like that anymore. We're very heavily regulated and governed, and it's for particularly large private equity firms with great brand names, you do have a quality outfit that individuals should feel comfortable investing behind with, the knowledge that they are well-run businesses.
Well, if you want to find out more about PEP Gateway, head to pepgateway.com.au. We'll include a link in the show notes. But Cam, we always love talking to you. We always get so much out of these episodes, as I'm sure the Equity Mates community do as well. So thank you so much.
Thanks for having me again.
Yeah, thanks, Cam.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.